What's up, Squares? Harold Perkins here, and today we're going to talk about FHA loans. FHA loans are like Adam Sandler movies. Sometimes they're good, sometimes they're bad, but overall they're necessary, and things would be worse if we didn't have them. The Federal Housing Administration, or FHA, was established in 1934 as a part of the National Housing Act during the Great Depression. At the time, home ownership was out of reach for many Americans due to economic challenges.
Cash, I know, in this economy.
FHA was designed to provide mortgage insurance to lenders who made loans to qualified borrowers. By insuring these loans, FHA made it less risky for lenders to offer mortgages to borrowers who might not otherwise qualify. Yeah, that's right. Before FHA, there was no such thing as mortgage insurance or PMI, so you had to have 20% down to buy a house. So yes, in 1934, just like right now, saving 20% for a down payment was pretty much impossible for a lot of people. Mortgage insurance solves that. But we were all taught to hate mortgage insurance. So you have to decide if you hate renting more than you hate mortgage insurance. I hated renting more, so when I bought my first house, it was with an FHA loan. Here are the basics for qualifying for an FHA loan to buy a house. Minimum credit score of 580. So here's the thing about that. If you were to go look up the guidelines directly from the HUD website, what you would find is it states the actual minimum score accepted is 500. Yeah, that's right, but then why did I say 580? Well, there's guidelines and then there's real life.
This is real life.
See, the thing about sub 580 credit scores is that technically you can still qualify, but you cannot have had any major derogatory items on your credit during the past 24 months. Well, if you didn't have any major derogatory credit during the past 24 months, then you wouldn't have a score that's below 580. So, 580. The other reason is that if your score is below 580, then FHA requires your down payment to be 10% of the sales price rather than 3.5%. Okay, so on a $400,000 house, that would be a down payment of $40,000 instead of $14,000. An extra $26,000 in down payment because the credit score is below 580. Well, I theorized that if you had the extra $26,000, you would have paid the bills that caused your score to be under 580 in the first place. Then your score wouldn't be less than 580 and you could still do the minimum down payment. So part of the reason that your credit score might be lower is just that you have a very short credit history. Maybe because you're in your early 20s and just started using credit. Remember that this loan program is designed for first-time home buyers. Well, generally speaking, first-time home buyers might also have just recently become first-time car buyers or first-time credit card owners. And this is because they also tend to be first-time job havers. So if you're a first-time everything, then of course your credit history hasn't been established yet.
You have absolutely no prior credits.
FHA is cool with that because what you have done is pay for things that are usually not on a credit report. You've paid rent, cell phone, car insurance, and maybe even utilities. So no, these things are usually not on your credit report, so they don't help your score, but your mortgage broker can have them added to your credit report so that the underwriter can see your payment history on these items. Nice. FHA allows this, conventional loans do not, and conventional loans require a minimum credit score of 620. So the lesson on credit for FHA is that if you already have a credit history established, and it's been generally good over the past 2 years, then you are going to get approved. If you don't have a credit history established, then your payment history on your regular bills can be your credit history. Let's talk a little bit more about down payment. I mentioned earlier that the minimum standard down payment is 3.5% of the sales price. First, let's talk about the acceptable sources of the down payment. Yeah, that's right. The source of your down payment is a big deal. A really big deal.
What's the big deal?
Of course, it's totally acceptable if you already have the money sitting in your bank account already. But not everybody has that, so some people need help to put together the money for the down payment. Family members are usually the first stop. So yes, a family member can gift you the money for the down payment, but FHA is very particular and strict about how this is documented.
What's the big deal?
You and your family member will sign a letter that states that the gift money will not be repaid to the donor, and you will have to paper trail the transfer of the money from your family member to your bank account.
What's the big deal?
So FHA's thinking here is that if the money from your family member were a loan, then there should be a loan payment that gets counted against your qualifying. Maybe having that additional loan payment would make it so that you couldn't afford to make the house payment. You might remember back in 2008 when Senator Clay Davis was convicted of mortgage fraud. This was because he used money from his mom as the down payment for a house, but called it a gift. There was a signed gift letter stating that no repayment was required, but prosecutors had his emails stating that he would repay it and the bank statement showing the money transferred back to her. Now, I'm not suggesting that prosecutors are examining every single loan that has gift funds. The investigation into Clay Davis was originally for political corruption, and the loan fraud was found as a result of that investigation. I just want you to be aware of what it says on the documents that you'll sign. Also, Clay Davis was from a TV show. But it was a good example. But a lot of people also get their money for down payment by borrowing against their 401k. This is a great option if you have it. The 401k loan payments do not count against you in your qualifying. And by taking a loan rather than withdrawing it from the 401k, you're not subject to penalties or taxes for receiving the money. But don't forget that the 401k loan payments come from payroll deduction, so your net take-home paycheck is going to be lower. There are also down payment assistance programs or DPAs, but most of these suck. So the thing about DPAs is that right from the start, you're going to pay an interest rate that can be as much as 2% higher than regular financing. Yeah, that's right. So of course, the higher interest rate means a higher monthly payment. Well, it doesn't take long, usually less than a year before that higher monthly payment costs you more money than the assistance gave you in the first place. And most of the DPAs are not grants, they are loans. Yeah, that's right again. The DPA will place a lien against your house for the amount of the assistance. Now, there's usually not a payment due with the DPA loan. It's a silent second. And the DPA loan itself is usually forgiven over time if you meet all of the conditions. But some of those conditions are very restrictive. For example, some DPAs do not allow you to refinance the original loan for several years, or sometimes ever. If you did, then you would have to pay back the down payment assistance. What? Yeah, that's right. You had to take a higher interest rate on your mortgage to get the DPA, and then if interest rates go down in the future, you're essentially penalized for taking advantage of the lower interest rates if you refinance.
That's not fair.
Another common restriction is that you have to live in the house for a certain number of years. Okay, that doesn't seem like a big deal. After all, you bought the house with the intention of living in it. But what if your job relocates you to another city? Or what if you just get a better job across town, but now the commute would be unreasonable? Yeah, selling the house or moving out of it and converting your house into a rental property could land you owing thousands of dollars more than you realize.
That's not fair.
All in the name of assistance. I think that getting help from a family member or even delaying your timeline for purchasing to save the money for your own down payment is going to be a better option for you like 99% of the time. But if you consider using a DPA, just make sure you read all of the documents very carefully and make sure you fully understand all of the conditions and restrictions associated with it. Let's talk about income requirements for an FHA loan. More specifically, the debt to income ratios that are required. Debt to income ratio, or DTI, is the percentage of your monthly income before taxes that's being used for all of your other payments. FHA looks at your DTI in two different ways. First is just the house payment as a percentage of your gross monthly income. That's called the front or the top ratio. So for example, if you make $5,000 per month before taxes and your house payment is $1,500 per month, then your front ratio is 30%. The back or bottom ratio is the total of all your other monthly loan payments plus your house payment. So if you also had a $400 per month car payment plus $100 per month in credit card payments, then the total of all your payments is $2,000 per month, which means your back ratio is 40%. Well, FHA guidelines suggest that your front ratio should not exceed 31 and your back should not exceed 43. The idea here is that at these ratios, you should have enough money left over each month to eat, entertain yourself, and save a little bit. But did you know these are just guidelines? They are not set in stone. FHA loans can be approved with much higher DTI. But why would we ever want a higher DTI to get approved? Well, maybe you plan on having roommates that will pay you rent in your house. The rent does not always count towards your qualifying when you're buying the house. But in real life, that's real money that helps you afford a higher house payment.
This is real life.
Or maybe you're married, but your spouse is not going on the loan because of bad credit. Well, if your spouse is not on the loan, then their income does not count towards your qualifying. But in real life, that money is there and it's helping to pay the bills.
This is real life.
I'm just saying that guidelines are just that. Just guidelines. The cool thing about FHA is that with the right circumstances and the right documentation, guidelines can be expanded. Talk to your mortgage broker to find out if your loan application would be approved, even if you didn't exactly fit into all the guidelines.
It fits.
Okay, so we talked about credit, down payment, and debt to income ratio for FHA loans. But this is the end of the video. Subscribe to get the rest of my information on FHA, and thanks for watching. Later, nerds.